Welcome, everyone, to the Retirement Power Hour. My name is Joe Allaria. This is episode 34. On our last episode, we talked about how much life insurance do you need? In other words, what is the total death benefit you need? But once you figure that out, you're not all the way done. Next, you need to decide what type of life insurance do you need. And today, I'm going to talk about the difference between term life and whole life with my guest, colleague, and co-host, Jay Waters. So stay tuned. Welcome, everyone, again to this episode. Jay and I are looking forward to talking about whole life versus term life. And Jay, I'm going to toss it to you in just a second. But first, I'd like to say, anytime we talk about big topics like this is a contentious topic. But when we talk about any type of investment, any strategy, blanket recommendations and blanket statements are never good. So we're not here to say one type of insurance is bad and the other type is good, but there are certain arguments that are made at times, mostly about whole life, and they're mostly by the pro whole life side of the fence. And they're just, in my opinion, they're just ridiculous arguments. There's a time and a place for different types of insurance, but we need to make sure that we're giving a fair picture as an industry, as financial professionals, so that folks can make the right decision. So that's my disclaimer with that. Jay, let's get into it and let's talk about whole life and term life. And thought it would be a good place to start if you could just give us a basic definition of each type of life insurance.
Yeah, absolutely, Joe. Term life insurance, typically you'll have a level premium for that term policy stated over a certain period of time, whether it's 10, 15, 20, 30 years, it'll be a set coverage amount of time. Now, once that period of time ends, the insurance doesn't necessarily expire, but the life insurance premiums themselves, while they were level over that period of time, then will heavily increase. Mm-hmm. Best example I could give would be a 30-year-old purchasing a 30-year level term product. Right. Those levels will stay premium for 30 years until they reach 60. At that time, client or the insured has the option to then either renew or continue to pay on that price, on that insurance. It'll be a lot higher price though, or let the policy lapse.
Usually ill-advised to continue to pay those premiums because they're just going to skyrocket. So you have the death benefit while you're paying the premium, but it's temporary. That's a good way to think of term. It's temporary. What about whole life? Tell us, how does that differ from term life?
So on the whole life side, again, for the first part, pretty much stated the same way. Instead of it being a set length of time on how long the coverage will last, typically the coverage will last your whole life. Right. Hence whole life insurance. Then for the premiums, again, that could be a stated amount. It could be 10, 15, 30 years, could be to age 65. It could be also your whole life that you pay for them. Just depends on how the policy is designed. Right. Now, the extra chassis that comes with the whole life is the amount of premium that you're paying is typically higher, but you're not paying for just the life insurance coverage itself, but you're also paying for a percentage of it that goes towards what's called the cash value of the policy. So that enhanced premium, some of it's going towards the actual cost of the insurance, and then some of it's going towards a cash value benefit.
And just to jump in real quick, Jay, this is just basic understanding. Yep. Life insurance has a cost for everyone, or every type of insurance. And that cost goes up as you get older because the likelihood that you're going to pass away goes up as you get older. So the goal with whole life is they try to keep your premium level. And, you know, my cost of insurance is really low as a 30-something-year-old, but as I get older, it's going to get more expensive. So how do I keep my premium level when that cost is going up? Well, I stash some money over here in the cash bucket and try to grow that. And the whole life policies use the company dividend to grow the cash bucket. And then over time, cash from that bucket is being used to supplement your premiums, which really, as you get older, don't cover the full cost of insurance. But with the help from the cash bucket, you're able to cover your premium. And some people will design it, like we'll talk, to grow the cash bucket. They'll sell it as an investment, as a way to grow cash. So one of the arguments for a whole life is that you'll get your money back at some point versus term, where they'll say, well, you're going to put money in the term policy. Chances are you're not going to get that death benefit, because something like only 1 to 2% of term life policies actually ever pay a death benefit, which is good because that means you didn't die during that period.
Yeah. So what you have to do is look at the difference between what you're going to pay on that term coverage and what you're going to pay for that permanent insurance coverage. Usually there'd be a large difference between the two. An example from Ramsey Solutions actually is, if you take George as the example character, a 30-year-old who's healthy, the premium for a $250,000 term life insurance policy would be $13 a month. Right. For that same individual, a whole life policy would be $260 a month.
It's true. In a term life policy, chances are you won't get a return on the investment, which again, I argue is a good thing. But in a whole life policy, if you pay the premiums, if it's in force, there will be a return on the investment. But again, if we're talking, well, it's $100 a month here and $100 a month here, one of them you get your money back and the other one you don't. Yeah, obviously, the one that you get your money back is better. But we're talking about $13 a month versus $260 a month. That's a huge difference. And a lot of people, I would argue, if you can pay the premium, if you can afford it, maybe it makes sense. But I'm assuming that means that you are, that you have no high interest debt, that you have an emergency fund, you're saving plenty for retirement, you're saving plenty for all the other financial goals that you have, trying to build cash value in a whole life policy. Most people aren't able to do that at a younger age. They pay the $13 a month so that they can be covered, and again, use their money to use toward those other goals, Jay.
Yeah, all good points, Joe. And if you're looking for a lot of coverage for a smaller premium for a certain period of time, then term insurance fits that all day long. Right. Where when you mix that whole life into it, again, yes, it can make sense. But like you said, you have to be filling up those other buckets, not have high interest debt, saving towards retirement already. Then possibly, yeah, it could make sense.
And that kind of leads into the counter argument of buy term, invest the rest. What's that mean? Well, that would mean buy the term, it's $13 a month, and then take the $247 a month and just invest that possibly more traditionally, a diversified stock portfolio or mutual fund portfolio, something like that. But why would someone do that? Well, the thought is, because if I do that, the growth I would receive on investing in that way would be greater than the growth that I would receive in the life insurance policy. And that's the second major argument for whole life. And we'll get into this here, is talking about, well, do whole life because you're able to grow your cash, right? You can grow your cash. This was the number 2 reason on a major life insurance company's website, I don't want to mention their name, on why you should consider whole life, is the ability to grow cash, as if there just aren't a ton of other ways in the world to grow your cash that might be more efficient and might be better. But that was the number 2 reason. And the argument is such that on the website, at least, that cash value in a whole life policy can grow like a fixed income portfolio. So it can complement your bond allocation in your portfolio. And hey, the dividend has been 5%, has been 6% for however many years, right? So those numbers, you start to hear like, oh, that's not too bad. And one other claim that you may hear, the company's dividend or the growth of the policy is guaranteed.
It's one of those where there's a lot of things that play a factor into the whole life policy's returns, to what that cash value is equal to. And really what I would look at with this is, let's say you are that 30-year-old individual, is while you may be putting additional money aside within this whole life policy towards the cash value of this permanent product, do you really want or need fixed income like returns while you're 30, while you're 35, 40? The answer would be no. You want stock like returns. You want equity like returns when you're younger.
When I was younger, Jay, I kind of fell victim to this narrative because I thought, well, that makes sense. And, should have some stocks and have some bonds, and not knowing any better. Again, I'll just say I fell victim to that. But then as you get more experience, you kind of learn, and we have a philosophy of investing here. And yeah, when you have 20 or 30 years to invest. There's no way you should have any bond allocation, for in your retirement accounts and things like that, assuming that you can tolerate the volatility here. But, our recommendations and arguments would be no bond allocation until you get within 10 years of retirement. So, okay, cash value whole life or just whole life policies can grow similar to bonds. True. But if you're a younger person, you would never want to own any bonds. So the second thing, like I said, Jay, well, the dividend's been 5%, 6%, 7%. That sounds good. But what's the gotcha on the dividend rate when people are talking about how good the dividend rate has been? Do you actually get all of that return?
With those stated returns on the dividend rate, yes, that's what the dividend pays, but not all that dividend goes back straight into the cash value. There's, again, that cost of the insurance where a portion of that goes to. Typically, if you look at just a general basic whole life policy, your break even is usually 15 years for you to even get back to what you'd put in. Part of that's because of cost of the insurance, not all of it being allocated towards the cash value. But then also when you actually look at the best way to do it, it gets a little in the weeds, is when you look at what that dividend rate is, and then you take what the illustration will show you on what the cash value is, you have to look at what the internal rate of return is.
Right.
Typically, that internal rate of return is lower than what that stated dividend is. When you're proposing these policies, usually they say, well, you're going to get a 5, 6, 7% return, where there's a difference between return and dividend rate.
100%.
And those like to be commingled a little bit every once in a while when these policies are being explained to people.
And Jay, a lot of times, and I would say it's often, the dividends are being used to buy additional insurance.
Yep.
So there you go again. You're increasing your cost because you're buying additional insurance. Dave Ramsey says if you die with whole life, you don't get any of the cash. You just get the death benefit and they keep all the cash value. Well, traditionally that would be true, but so often now the cash is used to buy paid up additions. So what are you doing with your part of your dividend there? You're buying more insurance.
Yes.
Yep. If your death benefit goes up, it means you're taking more of your dollars, whether it's out of your pocket or out of the dividend, to buy more insurance. So the cost of more insurance is obviously higher. And we have so many things. I just want to keep going, Jay, and bringing up these other points. The third one was guaranteed. And I couldn't even believe my eyes when I saw this. Guaranteed growth on your cash value. And it had a little asterisk, a little number up there. You had to go read the fine print because yes, it's maybe guaranteed because all insurance policies, to my knowledge, have a minimum guaranteed rate. But I can almost guarantee that when they're sold, our dividend's 5% right now. Our dividend's 6% right now. That number is not guaranteed. That number changes. So is it guaranteed to grow? Is the illustration that I look at, and this is the big one, I look at, well, a lot of times when these are sold, you see an illustration, which is a projection of the future. Is that guaranteed? It's only guaranteed if at the top of it, it says guaranteed. And usually there's different columns. One will say guaranteed. It doesn't look very good. And the other one will say under current assumptions or something of that nature, current charges, current dividend. That's the one that you usually get steered to, which looks really good. That's not guaranteed. So that's the thing to understand about these illustrations with all types of permanent policies. They're not guaranteed unless it is in the name of the policy, like a guaranteed universal life, or it says guaranteed at the top of your illustration. And I think so many people are just steered the wrong way and they think their projections are guaranteed. And then maybe things change and the environment gets worse and they get a letter saying that their policy is going to lapse because they don't have enough cash in the policy. I don't know if you've ever heard of that happening, Jay.
Yeah, I've come across that. The third point of this is having that fixed like return or those fixed income like returns to eventually use for retirement, right? They're mixing it between investments and life insurance and saying, well, this can be then used for the future. The life insurance policy cash value grows tax-free and you can take out tax-free.
Yeah.
So Joe, maybe walk through yes, there is ways to access this cash value tax-free. 10, 15 years down the road, then you may have cash value in there to equal to what you put into. But anything before then, most likely you won't have what you put into the policy. So even if you did want to access it, what you put in is probably not what you have access to. And then down the road, when you do want to touch it, walk through different tax-free options to access to it, but also how it can become taxable.
Yeah, just on the tax front, you can get money out of the policy, but it has to, and you can do so tax-free, but those are not true withdrawals. And this is getting into the details here, but those are going to be coded as loans. That's the only way to get money out of the policy tax-free is you're taking a policy loan. Well, what do you have to do with a loan? You need to pay it back. What is usually charged on a loan? Interest. Someone might say, well, you're paying yourself back. Well, a lot of times these retirement illustrations, they don't ever include you paying the money back. And so you're good for a period of time, right? And then policy runs out, lapse, expires. So just understand that it's technically a loan. If you take a true withdrawal, then you are going to have to pay tax on the growth of that investment. So there's a difference there. But let me say this, some agents out there will talk about the ability to take loans to be your own bank. I'm kind of going to the next one, but to be your own bank. The term infinite banking, I've heard that used. I can use whole life and borrow from my own cash, so I don't have to go to the bank. That is not unique to whole life policies. And a lot of people think that this is the only way you can do that. Absolutely not. If you invest more traditionally in a stock and a bond portfolio, you can borrow against those type of accounts as well and do something called a collateralized brokerage account or securities-based loan. If you did want to take money out for a business or for whatever, then you can do that. And let me ask you this, like you said, Jay, if it takes 15 years for it to break even in a whole life policy, and it's growing like a bond portfolio, which is more conservative, and then on this side, the money I put in day one, I have access to, and it grows more like a stock portfolio, which one am I going to be able to take a bigger loan out on? The one that doesn't grow as much and takes 15 years to break even, or the one that I have full access to day one and it grows more like a stock portfolio? So that's just common sense. If you're in it to get future access to be your own bank, that is not unique to whole life. And probably the next one talking about is probably the most egregious in my opinion is, oh, you had a baby, congratulations. You should go ahead and start a whole life policy to pay for their college education. It's a great college education savings tool.
Why we don't recommend that, why we don't advise that is, one, the first place I start with is typically when you purchase life insurance, it's because there would be a financial burden on the person of if you passing away. Now, yes, emotionally it'd be devastating if a kid passed away, but financially wise, you didn't rely on a 5-year-old's income. And, if anything, kids are usually more expensive than being less expensive. So from a death benefit standpoint, there's really not a need besides maybe the funeral for a kid to have life insurance on themselves.
Exactly. If you want to get it for that reason though, Jay, you want to, have it. It is very inexpensive to kind of cover final expense, maybe to give something to the child in the future, a way that they can use the whole life policy and the cash in there. Fine. Don't tell me though that whole life, something that takes, we said 15 years, we talked, maybe you can design it to break even in 10 years. Don't tell me that something that takes 10 to 15 years to break even should be used for college, which max, you'd have 18 years for that thing to grow. Right. It just, again, common knowledge, common sense tells us that's not a good investment for college education. So again, I'm not saying don't buy a kid's policy. I'm not saying that there's not a time and a place for that. If that's something that makes you sleep better at night, something you want to do, totally fine. But for college education, once again, if I put money in a savings account that doesn't grow at all, I have full access. If I put 5,000 in there this year, guess how much I can get out this year? $5,000. So I'm equal with a whole life policy actually, I'm ahead of a whole life policy for the first 10 to 15 years by just using a savings account that earns 0% interest, because I can get to that money. And don't you know that things come up where I might need to do that? So flexibility is really key. You don't really factor that into the numbers, but it's really important. It's growing like a bond or growing like a stock. Which one's better there? So a lot of times nowadays, we share this so that if we're thinking college, people can make the choice of, well, this might grow better, and we don't have as much time. So we kind of need that to happen. And so rather than use whole life for college, use a college savings account, like a 529, where you can invest it in tax benefits, or even just a brokerage account, an UTMA account, a trust for minors. There's a lot of options. Whole life is not even on the list, in my opinion. It shouldn't even be considered for college education. And I'm ranting a little bit, but we're running out of time. Let me go to the next one, Jay, and I'll let you respond to this. Because a lot of people, this isn't really as much an argument I hear as much, but a lot of clients that come in, they've maybe had whole life policies for years. They have cash value, and so they're not choosing to buy one, but they have one. An argument might be, well, this is great because I can use the cash value for long-term care, so I'll just keep my policy. Well, what are your thoughts on that?
There are different ways. I mean, pros and cons to that, right? With the long-term care policies, it's one of those where, yes, you can often utilize the cash in the whole life to be used as a long-term care benefit, but that's going to eat into that cash value. It's going to eat into the face amount of the policy, because that will have to be paid back. The amount you take out will have to be paid back, or the policy could lapse, or if you pass before the policy runs out, then that would be taken off the death benefit. Usually there are other options that can be used. If you are looking to use a long-term care policy, you could use that cash value to use it to fund premiums for a long-term care policy. There's a lot of different options that then could be used for a long-term care policy outside of that.
Yeah, I think it's all about leverage, and nothing against if you have a whole life policy and you've had it for 30 years. Well, you can't go and undo that or change that, but maybe there is 30,000, 40,000, 50,000 in cash value. Now, a lot of times I see that on policies that are, 200,000 in a death benefit or 250,000 in a death benefit. And maybe you don't need that death benefit anymore because your portfolio is large enough that it will cover all of your obligations. So using the cash, can you use that and leverage the cash? And we just call it leveraging up your long-term care benefit. Because if we're just looking at long-term care, if I have 50,000 of cash value in a life insurance, a whole life policy, guess how much I can use for long-term care max? $50,000. But if I can leverage that 50,000 to get more benefit toward long-term care, something I now need more than just a basic death benefit, that could be a useful alternative as long as you're healthy enough to get approved. So we've covered, 5 or 6 arguments for whole life, just to try to give you the other side. And just a couple of thoughts, and we'll wrap up here, and I'll leave you with these, Jay. But not all permanent policies are whole life. I said that earlier. There's other types, and I value flexibility in any financial plan. So when you talk about other types, universal life, variable universal life, these all offer flexible premium, so you can alter your premium as it fits your needs. Guaranteed universal life, a type that is actually guaranteed. Like I said, it's in the title. So you pay your premium, you know what you get. So those are other types that can help you with those permanent life insurance goals to make sure you have a death benefit at the end of life. And we may cover that on another episode, because then you've got another type, indexed universal life, that a lot of people, again, try to use to solve all the world's problems. And I think, there's some error in doing that. Jay, any final thoughts on this, as people are, maybe they're thinking about what should I do, or maybe they have already made that decision. Maybe they're a few years in. I mean, what should they do if that's them?
If you're looking to purchase either a term policy, a permanent life insurance policy, or you already have one of each, reach out to us. We're happy to look through it with you, help you determine, does it still fit the needs that you're looking for? What is the right amount of coverage that you should have? Which one makes the most sense for your situation? Again, the two different policies are all situational, but making sure that you have an independent advisor or somebody who's not with a captive insurance agency help review that and help you make those decisions.
Yeah, 100%. A fiduciary, someone who doesn't have any skin in the game, and someone who can just give you a second opinion. So good advice there, Jay. And again, for all of those that are listening, be sure to go back, watch the previous episode or listen to it as we talk more about how much life insurance do you need. Life insurance is just one part of your overall financial plan, but we're kind of doing a little mini series here on it because it is part of what we go off of is the Certified Financial Planning Board of Curriculum. And that curriculum includes life insurance. It includes insurance planning in general, which is one of 5 areas: investments, retirement, taxes, estate planning, and insurance planning. So it's an important thing to do. So also don't forget, go to our website, retirementpowerhourpodcast.com. And if that's you, if you have questions about this, just click work with me, schedule a call with Jay or myself, and we'll be happy to talk you through these things. There's no obligation. There's no cost to do that. We'll have a conversation and see if we can help you. So Jay, thank you again for joining me today. Good discussion. I said before the show, we could have made this thing last 3 hours talking about this topic, but wanted to give some quick hitters and a little bit of information to just get people on the right track. But if you have more questions, feel free to reach out to us. And we will see you next time on the Retirement Power Hour. We help listeners invest wiser and retire better. Take care.